Well, good day, subscribers. Hope you guys are having a great day out there. As always, if you're new here, I am Jeremy, and today I'm going to teach you guys exactly how to make passive income by dividend investing through the Robinhood app. And dividend investing is a magical thing. It's a way you can compound money so your money makes you more and more money. So for instance, maybe at first you're only making like $20 a year from dividend stocks. Then you progress, you compound some money. Next thing you're making $40. Then you're making $100. Then maybe you're making $1,000. Then eventually over time you make so much money in dividend money you really can't even keep track of it, okay? So let's get into this. Alrighty guys, the process I'm about to share with you is actually much simpler than a lot of people would even realize, okay? So make sure you smash the thumbs up button if you enjoy me sharing this with you, and make sure you share this with a friend so they can start actually building some wealth, compounding money and things like that, because this is not the most complicated thing in the world. This is not the hardest thing to do in the world. It's actually, I don't want to say necessarily an easy thing to do, but it is certainly not a hard thing to pull off, okay? So let's start getting into this, okay? So first off, why should you go through the Robinhood app specifically? I think Robinhood is really phenomenal because a lot of people that start in the stock market and want to start building wealth, start buying dividend stocks, a lot of folks that are doing that are usually buying for hundreds of dollars at a time. Maybe they're trying to invest their first $1,000 or something like that. And so the Robinhood app allows you to place these trades, make these moves, start buying these stocks with no commission on it, which is absolutely huge, okay? Because most brokerage houses that if you want to go and buy a dividend stock, they're going to usually charge you $4.95 commission for every buy order and sell order you place, okay? Robinhood doesn't charge you anything, so basically every trade you get to place, you get to save $5 versus like a regular brokerage, okay? Now, I don't use Robinhood personally because I've been with the company that I've been using for over a decade now, and they do phenomenal work for me, so I don't want to like switch over to Robinhood. However, I cannot say anything bad about Robinhood, and if you're investing smaller amounts of money, it's generally going to be the app you want to go with because they don't charge commissions, and that means the world. When you're just starting out, you're investing your first $100, your first few $100, your first $1,000. Those $5 commissions can hurt your account in the short term, okay? So that's why we're specifically talking about the Robinhood app, okay? So what is the process you need to go through here, okay? The process starts with setting up a Robinhood account because you can't make passive income, you can't make any dividend investing money if you don't have your Robinhood account set up. So first thing is you need to set up that account. It's pretty much like setting up any bank account. You put in your information and whatnot, you get that up and rolling, okay? By the way, I just want to say this video is not sponsored by Robinhood. I had people, that work way up at Robinhood try to contact me about sponsorships. I don't do sponsorships. I'm not interested in them, so this video is not sponsored by them. But it's like we talked about, it just makes the most sense to go through them if you're investing smaller amounts of money. Unless you want to pay $5 commissions for each trade, generally Robinhood app's going to be the way to go, okay? So you set up your Robinhood account, then you need to find dividend paying stocks, okay? So if you don't know, like all stocks in the stock market don't pay dividends, okay? There's a lot of stocks in the stock market that I own even that don't pay any dividends. So basically you're counting on that stock going up in value over time, not paying you out dividends. And when I'm talking about paying out dividends, most companies that pay dividends, they do it every 3 months, okay? So you need to find companies that pay dividends. I have a ton of videos on my channel, talking about different dividend stocks. And there are a ton of other videos here on YouTube where other people are talking about dividend stocks. You can go to like Yahoo Finance. You can search lists of like top, yielding dividend stocks, or just the top dividend stocks in the Dow 30 and things like that, okay? Many of the companies that are in the Dow 30, which is like the 30 biggest companies, and the S&P 500, which is like the 500 biggest stocks, many of those companies pay dividends, okay? So finding companies that pay dividends is not a hard thing at all. It's actually really easy to find out what these companies pay. You can use something like Yahoo Finance, type in a ticker symbol. You want to look into Apple stock, for instance, right? Type in, Apple's ticker is AAPL. Type that into Yahoo Finance, you'll be able to see if it pays a dividend. It'll say right there on like the basically right when you get on the page, AAPL, it pays a 2% dividend yield or something like that. So you're going to be able to find plenty of dividend stocks very easily on the internet, okay? Then you need to start doing some research work, okay? Now, if you want to make passive income, you generally always have to put in some upfront work, okay? You always usually have to do something at first, so then it can generate you passive income. So what we're calling this now, the research work, this is your upfront work, so you can potentially essentially make, passive income, and this dividend money can roll in for months and months into the future, if not years and years into the future, okay? So how you're gonna research these businesses and these stocks, okay, is basically what you wanna look at. You wanna look at the 10K. So there's what's called an investor relations page of every public company out there, okay? So let's say you wanna go ahead and look into Coca-Cola stock. You're like, that's a stable stock, that's a great company. Like, people drink Coca-Cola and they drink the different products that Coca-Cola has, right? So you can go ahead and go onto Google, type in Coca-Cola investor relations page. It'll be the first thing that generally pops up. You go ahead and click on that, and all the information you could possibly want about Coca-Cola Corporation is going to be right there on that investor relations page to look into this dividend stock, okay? So you're going to want to read through the annual report, which is going to give you most of the information you could possibly ever want about the business model, what they're going after, what they're doing, what their progress has been over the past year. You want to read over the 10Q, which is going to look at the last quarter versus the previous year's quarter, where the business is going, what the challenges are, what the things are doing successfully, all those sorts of things. You're going to listen to the latest conference calls. All this information is on the investor relations page of all public companies, okay? And throughout reading this information or listening to these conference calls, you're going to go from not knowing very much about a business to having, so much knowledge on a business, like you were a high-level manager of that business or something like that, almost within like a few hours time, okay? And you can, read over these reports again. So if you don't catch everything the first report, go ahead and read over it again, because sometimes we lose concentration, right? You think you're like watching something, right? But you're actually thinking about something else. So you're not even retaining the information, or you think you're reading a book, but really your mind is somewhere else. And so you're going throughout the pages, but your mind is somewhere else. You're not retaining information. So sometimes that's going to happen if you read a 10K, read a 10Q, listen to a conference call. The trick is you want to go over it again and again until you've retained all the information. Your mind is at a point where you fully understand that business model. Now, once you fully research the business, what the competitors are, all those sorts of things, now you're going to start to be able to, get a good understanding of what that business is going to do over time, okay? And if you can see that business increasing, so you got to ask yourself, do you see the business, meaning the revenues, the net incomes, do you see that increasing in future years? Do you see that increasing in future years? And after you've gone through all these reports and the conference calls, you should have a pretty good understanding, like, oh yeah, I can see this business increasing their business, their revenues, their net incomes, their profits in future years. Or, you know what? I don't think so. I think this is a business that's downtrending. You should be able to formulate an idea after you've gone through all that information, okay? People wonder, like, how do you have such conviction on if a business model is going to increase in the future or decrease in the future? The reason I generally know these things is because I've gone through all the reports, I've read about them, and so I'm understanding the business on a whole other level than like the average person would understand this business. Because you might hear Coca-Cola Corporation and you might just be like, oh, I know some of their products, but I actually don't know if their business is going to increase. It's like you'd be, guessing. If you've read all the reports on that company, you should be able to say with conviction, yeah, their business is going to be increasing over the next 5 years. No, their business is not going to be increasing over the next 5 years because they have blah, blah, blah competitor, because that business is declining, because that sector is declining or whatever, okay? That's how you really understand a business on a high level and if they're going to be increasing, okay? Now, if you see the business decreasing in the future, then that's a no stock, meaning it's not worth investing in, because you never want to be investing in businesses that are in decline, that you can see like over the next 5 years, their business is going to decline more. If you don't have faith that their business and their net income and their revenues and all those sorts of things are going to increase in future years, then it shouldn't be a stock you're investing in, because you're trying to make passive income dividend money from these stocks in future years. So you're not trying to trade in and out of these stocks all the time. You're trying to buy a stock that you feel comfortable putting your money in for the next 3, 5, 7 years, okay? So you've got to find businesses that you feel comfortable with investing in, that you fully understand the biz. How do you fully understand the biz? Go through all those different reports. And if you've gone through the 10K, 10Q conference calls, you've read about it time and time again. You're like, I've gone through these reports 3 times. I still don't understand what that business does. Then that's a no stock. You don't want to invest in it. Never invest in anything you do not fully 100% understand, whether we're talking stock market, real estate, where we're talking, you're giving your money over to somebody so they can invest it for you. If you don't fully understand where your money's going and what that company's doing, don't invest in that stock, okay? You've got to fully understand it, and you've got to see that business increasing in future years. And if you've gone through all these important reports and you can't give me a yes on both of those, don't invest in, okay? But let's say, yes, you see that business increasing over time, you fully understand the business, you're like, I know what they do, man. I know what they're going after. I know what their goals are over the future years. Great, okay? Now we can go over here and we can look at their balance sheet. This is very important. So balance sheet, think about a balance sheet in this respect, okay? Imagine you have a balance sheet. You watching this video right now, you have a personal balance sheet, okay? You might own a home, okay? This might be an asset for you unless you're underwater in the home and you basically owe more on the home than what it's worth, okay? But you might have a home, so that is an asset for you, right? It goes under the asset category, all right? You might own a car, okay? Now, if you own that car, straight up and you're not underwater on that car, then it's a partial asset for you, okay? So let's say your car is worth $5,000 and you don't owe any money on that. You got a $5,000 asset there because you could sell it to today or tomorrow for $5,000 and go ahead and take that money and do something else, okay? Liabilities are like debt. If you have a massive amount of credit card debt, that's a liability. You have your own balance sheet in your life, right? You have assets versus liabilities. Same exact thing for companies. They have assets versus liabilities. But specifically what interests me when it comes to a stock or a company, I'm looking at how much cash they have, which cash is a line item on a balance sheet. How much cash do they have? How much in investments do they have? Short-term investments, long-term investments. And I go ahead and add up those numbers and then I subtract how much debt they have. And so I'm looking for companies that not only pay dividends, have an increasing business model, and I can fully understand it, but also have more in cash and investments than they do debts, okay? Now, if they do have more in debts, it can't be like a substantial amount more or it's too risky at that point in time. If you're talking about a debt-laden company that has, let's say, 10 times more in debts than in cash and investments, that's a little risky because what happens if a recession happens? What happens if that company's business model is hurting a little bit in the short term? Remember, we're trying to make dividend investing money, passive income money. We don't want to be having to trade in and out of these stocks all the time. We want to be investing in companies that we feel comfortable in the next 3, 5, 7 years. If you're investing in a company that has massive loads of debt, hardly any cash or investments on that balance sheet, you're sticking yourself in a risky situation. That's what you're going ahead and doing. You're sticking yourself in a very risky situation that if that company goes bad, you're going to be stuck in a real hard situation and maybe trying to trade in and out of that stock, which is not your goal. Your goal is to make passive income, dividend money overall. We don't want to have to be worrying about getting in and out of these stocks when you're trying to do something like this, okay? So make sure you're finding companies that have great balance sheets, loaded on cash, loaded on investments, and have as little debt as possible, okay? Those are winning balance sheets, all right? So let's say the balance sheet's great. We can move on to the next step. By the way, if the balance sheet's garbage, they have tons more in debt than they do cash and investments, it's probably not worth the risk, okay? But let's say it has a great balance sheet. Okay, now we go to the next step, which is we're going to look at 3 different things in relation to the dividend, okay? First thing we're going to look at is the dividend yield, which means how much money you get paid out based upon the current dividends the company pays, okay? So let's say a stock is $100 a share, okay? Let's say the stock's $100 a share and they pay out $2 a year in dividends. Well, that means they have a 2% dividend yield because you go ahead and take 100 divided by 2, well, you're going to get 2%, okay? So the company's basically, you're going to make 2% on your money based upon current dividends, okay? Now, don't get too caught up in the current dividend yield because a lot of great companies, especially if they have increasing business, great balance sheet, they're actually going to up their dividend each and every year, okay? Great companies that are very well run, they'll up their dividends. So don't get too caught up in, oh, this stock pays a 2% dividend yield, this one pays a 4%, so the 4%'s better. Not necessarily, because if the other business has a great business that's increasing, great balance sheet, they're probably going to increase their dividend massively over the next 3 years, 5 years, 7 years, and the passive income will really start pouring in because they're just in a position of power versus some other companies that have really high yields, see businesses declining. Those type of businesses are actually in a position of weakness, okay? Next thing I don't want to look at is what's the dividend history for the stock. So basically you can go to Yahoo Finance or something, go to historical data and go to dividends only and back it up the last 10 years, and you're going to be able to look at the dividend history for whatever that stock is, okay? So let's say you're investing or you want to look into Pepsi stock and you're like, oh, this is a great business model. I can see it increasing. I understand it. Good balance sheet, okay? I can invest in this company. So you're looking into Pepsi and you're like, well, what's the dividend history with this stock? So you go on Yahoo Finance, go to historical data, go dividends only, back it up for the last 10 years, and you'll be able to see, oh yeah, this company is paying out dividends every 3 months and they're increasing every single year. Those are the type of companies we really want to get involved with if you're talking about making passive income, dividend income, okay? You want to find those type of companies that have great dividend track histories, not companies that just started paying dividends yesterday. Those are risky. I mean, how do you know they're going to keep that dividend? They just started started paying it or something like that, okay? You want companies that are proven that they can up those dividends each and every year, okay? And they pay them every single 3 months, all right? Also, you want to look at the dividend payout ratio. This basically means of the earnings per share, how much are they already paying out in dividends? So let's say you have a stock and they pay out $10 per share in dividends per year, all right? And they have EPS a year of $100 per share, okay? That means they have a 10% payout ratio, which means they could up that dividend massively in future years, okay? That would be an ideal situation, okay? Let's say there's a company, it has EPS of $10 per share each year, okay? $10 of EPS, and they pay out, $2 in dividends. That means they have a 20% payout ratio, which is generally very low. We're really looking for payout ratios below 50% if it's ideal, okay? Ideal situation is payout ratios under 50% because that means they have a lot of wiggle room to up that dividend in future years if they just make as much money as they did last year. Never mind if they increase that business, now they could up that dividend even more, okay? Which is a beautiful, beautiful thing. So dividend yield, we're looking at dividend track record, like the history of that stock paying dividends, and the payout ratio, okay? Very, very important. Now, everything looks good there. We can move on to the next step, which now you got to invest whatever you feel comfortable with, okay? So you found the stock, you're like, okay, everything's checking out, balance sheet, the track record, all those sorts of things, the business increasing, I understand it. I'm ready to invest this stock. Now you got to choose what's your comfort level with investing, okay? So maybe you feel comfortable investing almost all your net worth in that one stock, okay? If that's you, do what you want to do, okay? But you're generally going to want to go with a disciplined approach, okay? So let's say you got your net worth's $1,000, okay? You got $1,000 in a savings account, and that's, what you have for money right now. You might feel comfortable just investing $100 into it for now, maybe $200, maybe $500. Do whatever amount you feel comfortable with at that particular time. Don't invest too much where it's at a point where you don't have comfort. You're like, can't sleep at night because you're worried about that money and what's going to happen. Because remember, in the stock market, stock prices move up and down all the time. We're not so worried about that if we're focusing on dividend investing, right? Because our focus, if you're a dividend investor, your main focus is getting dividend money, making that passive income constantly, and then reinvesting that into other dividend stocks so they can make you more money, and the money can compound and compound. Remember what we talked about at the beginning of the video, compounding and building that money, and you're receiving this much one year, and then you're receiving this much the next year, and you just keep building and building, okay? So we're not so worried about stock prices, but still, you're going to see stock prices moving up and down all the time, because this is a stock market, there's volatility. You got to invest what you feel comfortable with. And at the same time, don't invest too little where you're not even thinking about it, okay? Let's say you got a net worth of $10,000 and you invest $100 into a stock. That's such a small amount of your net worth that you might not even care if that stock goes up or down. It might not affect you. You want to invest enough where it puts you maybe slightly out of your comfort zone, but not so much where you're so worried about that money and losing that money and what happens if the stock goes down and blah, blah, blah. You don't want to put yourself in that position. So you're trying to find that happy medium where you're a little out of your comfort zone, but you're not so much where you're like freaking out every time the stock market goes up or down or something like that, okay? And the next step is you basically sit back and you collect dividend money for future years. You keep an eye on things. You keep an eye on what's going on with that stock. No different than a real estate investor would keep an eye on the property and maybe walk the property once a year or something like that. Or maybe they got to, get a phone call and it's like, hey, we need the sink fixed. The sink isn't working or something like that. Okay, there's a little work you got to still do, but for the most part, you're not worried about this stock every day. You're not even worried about it every month. Maybe you keep track of what happens on the quarterly reports every 3 months. So every 3 months, you listen to the conference call and you read the 10Q and things like that. Okay, what's that take? A few hours time every 3 months? We're not talking about a lot of work you're putting in. This is much of just passive income you're making. This isn't like having a job and you're collecting this money. You're collecting this passive income. These dividend stocks are thrown off. And then you go ahead and you take that money and you invest in more and you go through the same exact process again. You find some more dividend stocks. You look into them. You research them. You figure out if the businesses are great. If they're increasing, likely to increase. You figure out the balance sheet, the yield, all those sorts of things. You find the next stock. And then you'll start receiving more and more dividend money. And then you'll invest that even into more stocks and you'll start receiving even more dividend money. And it's just like a mountain that keeps building and building and building. And as long as you do it successfully and you're doing the research work, the initial work, so you can make that passive income in future years, as long as you're doing that initial work, you should be able to, build a ridiculous fortune in a matter of 5, 10, 15, 20 years into the future. You just got to do the upfront research work so that passive income can just kind of plow in, and then you just kind of maintain things. Every 3 months you look at the reports. How's that company doing? Is everything still going according as planned? You know, if you're dividend investing, you shouldn't be worrying about the stock price too much. It's more like, hey, what's going on with the business overall? What's with the fundamentals? Is everything still playing out the way I thought it would play out? And if it is, great. You should make a lot of dividend money and build and build and build in the future. And that's how you make a lot of passive income money, through dividend investing. And you can use the Robinhood app for something like that. You can use other brokerages to do it as well. It's just Robinhood's free to do trades, and that $5 is going to save you each and every time, especially if you're investing smaller amounts of money, guys. So make sure you hit a thumbs up if you enjoyed me sharing this. I gave a lot of detail here about how to research a dividend stock and things like that. So I hope you guys really appreciate it. Make sure you share this out with a friend or a family member who wants to start building wealth for themselves. All right. Thank you for watching. Have a great day.